Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastep Jr.
Hello and welcome back to the Ask Ralph Show. I'm glad you joined us today. If you've not listened to our program before, I want to say welcome. My name is Ralph Eastep Jr. I run an accounting practice in Middletown, Delaware, and I do this show every week on the AM radio, and it also gets rebroadcast on the iHeart Radio app, as well as we develop a podcast. So there's a whole library out there at AskRalph.com, or where you get your podcast. You can hear more of the topics we talk about. But I want to welcome you today. One of the things I want to talk about today is something that I get asked quite a bit. And that is, Ralph, what are some things I can do to avoid getting audited? So I found an article here by the Motley Fool. And basically the title of the article is "Make These 4 Tax Mistakes and the IRS Could Come Knocking." So we'll talk about it from the opposite direction. So what are some things that will pretty much guarantee that you're going to get a knock on the door? Well, not figuratively, but figuratively you're going to get it. They're not going to come to your house. They're going to send you a letter and say, "Hey, John, you forgot to report something." So what are those 4 things? Number 1, you forgot to report some of your income. This is the surest way to trigger an audit, is to hide some of your money from the government. And it doesn't matter whether it was intentional or not. The government is not going to forgive you when it comes to reporting the wrong taxable income, especially if it's off by a large amount. Now, how does the government know that? A lot of people don't understand that. When you work for someone and someone pays you, they are obligated to send either a W-2 form or a 1099 or some other document to the IRS stating that you had earned this income. So it shouldn't come as a surprise when you get a notice, and it's usually a year and a half later when the IRS finally gets around to doing some matching. And they call you and say, they send you a letter and say, "Mr. Jones, it appears that you forgot to report something on your tax return." And that's why you really need to pay particular attention if you're doing your own tax return, or even if you're giving it to somebody else to do, like myself. Make sure you think about all of the work that you did that year. It happens frequently that a client will say, "You know what, I forgot I did do that part-time job, or I did make that, I did work there for a couple weeks," or something like that. And maybe a business has closed up, or, maybe you just totally forgot about it. Maybe you've moved and they didn't send you your W-2 form. But that is a big part of this. Don't forget to report all of your income. So that's number 1. Number 2, and this one should not come as a big shock, and that is, if you try to deduct charitable donations, you can't prove. Now, that being said, I want to say something that's really important. A lot of people don't understand when I say this. If you have the documentation to prove deductions, then it is absolutely fair and just to take those deductions. But if they're not legitimate, you can't prove them, this is going to be a problem. One of the things it mentions in this article, it says you should only claim donations you've actually made. Promises don't count. And only donations to qualified tax-exempt organizations are tax deductible. And that's a big part of this. A lot of people don't realize this. You go to like a GoFundMe or something like that. That's not necessarily tax deductible. The IRS code is very clear about charitable contributions, and it says it has to be to an approved charity. Now, you can go to irs.gov and look up those charities and find out whether they're an approved charity. And then, depending upon the type of organization, the donation range could be from one, piece to the other. But the key is to keep records of everything. That would mean you'd have your bank or credit card statements, and you cancel checks to document it. And if you donated $250 or more, you need to get a written statement from the organization. And the same goes along the same lines if you're doing any non-cash donations, like to Salvation Army or the Goodwill. You're gonna have to include a form called 8283 form. And you got to put the fair market value. Now, this is something a lot of people don't know. If you give non-cash donations which total more than $5,000 in a year, now I don't mean individual donations. I mean, these could be, 10 donations throughout a calendar year. The IRS code actually requires you to get an appraisal. Now, I had a client in the other day, and we had a long discussion about this. And he absolutely couldn't understand, how was he going to get things appraised? And I said, you know what? You make a valid point. And that point is this, are you really going to call an appraiser out to appraise the things that you would usually sell at a garage sale. But unfortunately, I don't make the rules. And that's what the rules say. If you're going to donate more than $5,000 in a calendar year, you have to get an appraisal. So that was number 2. Number 3 is you deduct too many self-employment expenses. This is just like the charitable contribution discussion. There's nothing wrong with deducting your expenses if you're running a small business. But the abuse of these deductions makes the IRS look more closely at it. You need to keep receipts and records of all of your business information. You want to have a separate bank account if you're running a business, a separate credit card. Keep track of all the income and expenses that are coming in. You got to have all those things, all the receipts. Maybe you have a logbook for all your work, all your driving that is, involving your work. It's not going to prevent the IRS from auditing you, but it's a very great feeling when you get that audit letter and you can say to yourself, hey, self, guess what? I've got all these documents that I need, so I have no fear. Now, number 4 goes along the same line, and that is what they say in this note, in this article, you round your numbers too much. And clients kind of think this is funny when I say this, but, if you come in and said, Ralph, I run this, arcade on the side. And, I'll ask them, well, what did you spend on advertising? Oh, I don't know, about $300. Well, what did you spend on office expenses? Oh, about $200. And this is a red flag thing, Right here it says, too many round numbers could be a sign that you're fudging how much you earned or how much you spent on business deductions. You may not get in trouble for rounding to the nearest dollar, but if you round to the nearest $10 or the nearest $100, the government may think you're trying to cheat on your taxes. If you're unsure of the exact cost of deductible expense, it's better to check your receipts than to estimate. And remember, you don't have proof of the expense, you can't deduct it. And that's at the time that you make that tax return and make that deduction, you've got to have that proof right then and there. I've had clients ask me that. Well, Ralph, if I ever get audited, I had to go back and, put my records together. Well, technically, that's not the way the IRS code works. Now, I'm not the world's policeman, so it's not my place to sit here and say, well, this is the way you're going to have to do it. But the truth is, you really need to have receipt evidence of those things. And don't play the game of, well, let's see, I'm going to say advertising was $207. And then, entertainment was $412 just to make up bogus numbers. Because the chances are, if you don't have a lot of income, you're not going to get audited. But boy, if you do, then you're going to be in a world of hurt when the IRS auditor says to you, okay, Mr. Jones, I want you to substantiate, is what they would call it, all your income and expenses. And you might say, okay, well, that's not a big deal. I'll pull out my statements, but you need to have those receipts. And clients ask me all the time, Ralph, do I really need to keep those receipts? The answer is yes. So I hope this was helpful talking about, these 4 things that may trigger an audit. So check us out.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.